I want you to imagine a beloved local company, your national champion, the absolute pride of your country's economy.
Right, the kind of company everyone knows.
Exactly. And today is a massive day because they have just decided to go global. So picture the CEO standing on that famous balcony overlooking the floor of the New York Stock Exchange.
Oh yeah, the classic photo op.
Yeah, the hammer comes down, the opening bell rings, the confetti drops from the ceiling, and like everyone on the floor is cheering.
It looks amazing on television.
Right. If you're watching this on the news back home, it looks like the ultimate victory lap. You just assume, wow, this is a massive influx of global capital, immense prestige, the pinnacle of corporate success.
Well, I mean, it is entirely designed to look that way. It's built to be a moment of absolute, undeniable triumph. Or at least, that's the narrative we're all fed.
But what if that narrative is, well, what if it's a trap?
A very well-disguised one, yeah.
What if I told you that the ringing bell you're hearing is not a celebration at all? What if it's actually the sound of a surrender?
And not just like a minor compromise either.
No, a silent, bloodless surrender of sovereign power.
That is the jarring contradiction we are pulling apart today. Because when you strip away the confetti and you look at the raw microscopic data, that victory lap is a complete illusion.
We're getting into a stack of research today that, frankly, it made my jaw hit the floor.
Yeah.
We're looking at a truly exhaustive 6-month study of high-frequency trading data.
It's an incredible piece of work. It was conducted by 2 researchers, Cheol from Georgia Tech and Sanjiv Sabherwal from the University of Rhode Island.
And the data they uncovered, it completely, irreversibly shatters how we think about global finance. So welcome to the deep dive.
Thanks. I'm really excited to get into this because, it shatters a very specific, very comforting lie.
Let's lay out the mission here for the listener. What is the lie?
Well, when the public and, frankly, even a lot of seasoned investors, when they look at a cross-border listing, meaning a domestic company deciding to dual list its shares on Wall Street, they just see the benefits.
All right, they see deeper pools of liquidity.
Exactly. Cheaper financing. A big global growth story. But beneath the surface, hidden in these microscopic fractions of a cent, there is a ruthless, invisible migration of power taking place.
We're talking about the loss of pricing sovereignty, right?
Yes. We are talking about a country literally handing the steering wheel of its own economy to a foreign superpower. They're giving up the valuation of their own national assets.
Because this deep dive isn't just about stocks moving up and down on a screen. I mean, this is a high-stakes battle over who controls the global truth, who gets to set the price.
And as we're about to show you, going global almost always means losing control at home. It's a silent capital war.
A silent capital war. I like that phrasing.
It's being fought every millisecond of every trading day. And the home countries are losing entirely. If you picture a giant balance scale, the weight is just slamming down on the New York side.
So let's back up and tackle that comforting lie you mentioned. Because for decades, the absolute smartest people in academia, top financial regulators, they all fundamentally believed a very simple myth.
They believed that the home market always controls its own prices. It was just treated as common sense.
And if you use basic intuition, it does make sense, right?
Yeah.
Historically, regulators assumed that because a company is headquartered in a specific country, the local investors possess this insurmountable edge.
Right. The locals read the local financial news every morning. They buy the local products. They run into the executives at the grocery store. The assumption is simply that proximity equals superior information.
And in financial markets, information is basically the only currency that matters.
Precisely. So the bedrock assumption of traditional finance was that because local investors hold the best information, the local exchange naturally dictates the true price discovery.
Okay, let's define that for the listener. Price discovery is basically the phrase that this entire deep dive hinges on. What exactly are we discovering?
Right. Price discovery is simply the market's ongoing, real-time search for an asset's true equilibrium price.
Like finding the absolute fair value.
Exactly. It's the mechanism of taking in millions of fragmented pieces of information, earnings reports, geopolitical news, consumer sentiment, crushing them all down into a single, undeniable number.
What a share is actually worth at this exact second.
Yes.
Yeah.
And the traditional academic belief was that this search for truth always ends at home.
But Eun and Sabherwal's data, it delivers a ruthless slap in the face to that traditional theory. The locals do not always win. In fact, they're getting slaughtered on their own turf.
And what's wild is that the alarm bells actually started ringing years before the study was even published.
Right. To really understand the stakes here, We have to travel to Toronto. The year is 1998. The Toronto Stock Exchange. The TSE.
Which, at that time, was not a secondary player. It was a massive powerhouse exchange.
A total juggernaut. I was looking at the historical context, and in 1998, the TSE represented 90% of all traded equity value in Canada. 90%.
They were the undisputed king of the Canadian financial system.
Yeah, over 2 billion Canadian dollars worth of trades were clearing their floors every single day.
A monopoly, basically, for all intents and purposes. And yet, if you look at the internal communications from that era, behind closed doors, there was absolute existential panic.
I actually read the TSE Board of Governors report from that year.
Yeah.
And there's a quote in it that, well, it does not sound like a confident monopoly. It reads like a cry for help.
What did they say?
They wrote, and I quote, "The TSE cannot afford to have the U.S. markets become the price discovery mechanism for Canadian interlisted stocks."
Wow. I mean, that is a deeply terrified statement from a board of directors. But to grasp why they were panicking, you really have to read between the lines.
Because they aren't complaining about losing commission fees.
Exactly. They aren't just worried that a few traders in New York are stealing a sliver of their daily volume. They are terrified of losing the mechanism itself.
The right to decide what their own domestic companies are actually worth.
Right. But let's play devil's advocate for the listener here.
Sure. Yeah, let's do it.
If I am the TSE, and I still control 90% of the trading volume in my country, why do I care if the New York Stock Exchange handles a tiny piece of the pie for a few dual-listed companies? Why is that an existential crisis?
Because losing price discovery isn't just losing business. It's the financial equivalent of a border collapse.
A border collapse? I mean, think about that.
Let's say you have a flagship national company, a massive bank, or a huge telecom provider. It employs tens of thousands of your citizens. Its health dictates your national pension funds.
Right.
If the true valuation of that company, the mechanism that decides if its stock plummets or skyrockets, if that is being dictated by traders sitting 500 miles away in a completely different country, do you even have a sovereign economy anymore?
You don't. You're saying the geographic border basically becomes a phantom.
Completely. You don't have a sovereign financial system. You have a satellite economy. You're just a shadow market, echoing a truth that's being determined by a foreign power.
So Eun and Sabherwal decide to test this exact fear. They want to prove, mathematically, irrefutably, who really sets the price, like taking a scalpel to this whole system.
But you can't just look at any random stock to prove this, right? The global markets are too messy?
Way too messy. Too many variables. They needed a flawless testing ground, a perfect laboratory to isolate the data.
And the Canadian market in 1998 provided exactly that. It was an unprecedented perfect storm of data.
So here's the setup for the study. They took 62 Canadian stocks. These were specific companies listed in both Toronto and the United States, so trading on the NYSE, AMEX, or Nasdaq.
And they tracked every single movement for a solid 6 months, right? February to July 1998. That is 124 trading days.
Yes. And we need to emphasize the scale here. They didn't just look at the closing price at the end of the day. That would be way too crude.
Oh, no. They looked at intraday quotes at 10-minute intervals all day long.
39 distinct prices per day, per market, for every single stock. We are talking about roughly 5,000 observations per stock. They were interrogating the market at a microscopic level.
But I have to ask, why Canada? Why not study British companies trading in New York or Japanese companies? Why was the 1998 Canadian market the holy grail for this?
Two incredibly critical reasons that basically eliminate the noise that plagues other markets. First, and probably most importantly, the time zone.
Ah, right. Toronto and New York operate on the exact same clock, Eastern Standard Time.
Exactly. The opening bell rings at 9:30 a.m. in both cities. The closing bell rings at 4:00 p.m. in both cities. There is zero time delay. They are open, highly liquid, and trading against each other at the exact same millisecond.
So it's a simultaneous brawl.
Yes. If you try to study a European company, say a German automaker listed in New York, the Frankfurt Exchange is often closing just as Wall Street is waking up.
You can't measure a direct, real-time fight over price discovery when one combatant is asleep.
Exactly. With Canada and the U.S., they are staring each other in the face for 6.5 hours a day.
Okay, that makes perfect sense. What's the second reason?
The structure of the financial instruments themselves. When an Asian or European company wants to list shares in the U.S., they usually have to use a complex financial vehicle called an ADR, an American Depository Receipt.
I've actually seen those in my brokerage account. An ADR is basically a financial wrapper, right?
Think of it like a claim ticket at a coat check. An ADR is a receipt for shares of a foreign company that are physically held in a vault by a foreign bank.
And because it's a receipt, it introduces a ton of friction.
A massive amount. It's priced in US dollars while the home stock is in yen or euros, meaning constant currency fluctuations. It carries bank conversion fees, distinct regulatory hurdles. It's just messy.
But Canadian stocks,
Because of a unique regulatory treaty, they trade in the US as ordinary shares.
meaning there is no wrapper?
No wrapper at all. The exact same legal certificate that gives you ownership in Toronto gives you ownership in New York. No legal restrictions, no bank conversion fees. It is the purest possible overlap of two markets fighting over the exact same asset.
Okay, let me try to build an analogy here to make sure we're locking this in for you, the listener. It's like setting up a perfectly controlled science experiment.
Okay, let's hear it.
Imagine you have two identical twin siblings running competing lemonade stands. They set up their stands on the exact same street corner. They open for business at the exact same time.
The time zone overlap.
Exactly. The recipe for the lemonade is identical down to the molecule. The cups are the same. The product is fundamentally interchangeable.
The ordinary shares.
Right. So if they're both selling the exact same thing to the exact same crowd, who dictates the true price of a cup of lemonade?
That is the ultimate question. If the twin on the left suddenly drops their price by 50 cents to attract a crowd, does the twin on the right have to match it immediately to survive?
Or do they stand their ground, fold their arms, and force the twin on the left to raise their price back up?
And to find out who submits, we have to look at the invisible forces that connect those two stands. Which brings us to the core mechanism of how modern markets actually function.
Because if you're a casual observer and you pull up a stock chart of these 62 companies on Wall Street and then pull up the chart in Toronto, they might seem to bounce around independently.
A little random noise over here, a little random noise over there.
Right, but the terrifying truth is that they are not independent at all. They are chained together.
They are bound by an unbreakable mathematical law.
When those two prices pull apart, someone has to submit. Someone always blinks first.
This brings us into the realm of co-integration. Now, I know that sounds highly academic, but the concept is actually incredibly elegant. In the study, they ran rigorous statistical tests to prove what we can call the one-to-one iron law of cross-listed pricing.
The invisible rubber band. Explain how this rubber band works.
Let's go back to the ordinary shares. Because we established that we are talking about the exact same asset, an ordinary share with no friction, the price in Toronto and the price in New York must, fundamentally, represent the same value.
Right. Once you adjust for the daily currency exchange rate between the Canadian dollar and the US dollar.
Exactly. One share of a telecom company in Canada is legally and functionally worth the exact same as one share of that company in the US.
Because an ownership stake is an ownership stake,
Right.
regardless of where you bought the piece of paper.
Yeah.
That's the one-to-one law.
Correct. That's the long-term reality. But markets are chaotic. In real time, minute by minute, second by second, prices drift.
A massive buy order might hit the floor in New York, causing the U.S. price to spike up by a fraction of a cent, while Toronto hasn't registered the move yet.
So the rubber band stretches, a gap opens up. But why can't that gap just stay open? If I'm trading in Toronto, why do I care if the stock is a penny more expensive in New York?
You might not care, but the financial snipers absolutely do.
Yes, the
Yeah.
arbitrageurs.
I love this part of the deep dive. We need to talk about arbitrageurs because they are the ruthless enforcers of the market. Explain to the listener what an arbitrager is actually doing when that gap opens.
An arbitrager is not an investor in the traditional sense. They do not care about the company's fundamentals, their product pipeline, or their CEO.
No, they don't care about any of that.
They sit in front of banks of screens looking for one thing and one thing only: a pricing discrepancy across two different markets for the exact same asset.
Okay, so let's say a Canadian bank stock is currently trading at the equivalent of $10 flat in Toronto.
But over in New York, because of some momentary buying pressure, the price ticks up to $10.01.
A 1 cent difference. I mean, most people wouldn't even bend over to pick up a penny on the sidewalk.
But to an arbitrager, that penny is a gold mine because it represents a mathematical certainty. The arbitrager strikes instantly. With high-speed execution, they buy 10,000 shares in Toronto for $10.
And at the exact same millisecond, they short sell 10,000 shares in New York for $10.01.
And because they bought low in one place and sold high in the other for the exact same asset,
They just pocketed a risk-free profit.
Exactly. They just locked in $100 of pure profit in a fraction of a second with zero market risk. Now, imagine dozens of highly capitalized hedge funds doing this millions of times a day.
What happens?
The sheer brute force of their activity buying the cheap shares in Toronto drives the Toronto price up, and selling the expensive shares in New York drives the New York price down.
The invisible rubber band violently contracts. The one-to-one relationship is restored by force.
The arbitrageurs are basically the gravity of the financial system. They ensure the gap never stays open for long.
Okay, so we know the prices are chained together. We know they always snap back. That's a given in modern finance. But here is where the researchers pulled off something brilliant.
This is the real breakthrough of the study.
Right, because the true secret of the global market isn't that the prices snap back together, it's how they snap back.
This is where we get into the error correction model. The researchers didn't just measure the size of the gap. They measured the flinch.
Break that down. What do you mean by the flinch?
When that price gap opens up and the rubber band is stretched, do both prices meet neatly in the middle? Does New York come down by half a cent and Toronto go up by half a cent in a perfectly fair compromise?
Or does one market stand perfectly still, unmoving, while the other market runs in an absolute panic to catch up and close the gap?
Exactly. The error correction model is essentially a forensic tool to figure out who is the master and who is the servant.
So what did they find?
The data reveals that it's a tug of war. The adjustments actually happen on both sides. Both markets react to the discrepancy to some degree, but, and this is the explosive insight, the speed and the sheer size of the adjustment reveal who the true master is.
The market that adjusts more, the market that has to do the vast majority of the moving, is the fundamentally weaker market. Let me try another analogy here because this dynamic is crucial. It's like walking a large, powerful dog. Technically, you are tethered to each other by a leash. You're bound together.
Like the co-integration.
Right. If the dog suddenly lunges forward to chase a squirrel, the leash pulls tight. The rubber band stretches. Now, because you're tethered, your arm is going to move forward a little bit. You have to adjust to the dog's movement.
We do.
But if you plant your feet, dig your heels in, and pull back with all your weight, the dog gets yanked entirely backward to where you are standing.
You're technically both moving, but it's glaringly obvious who is in control.
Exactly. The error correction model is mathematically measuring who is the human planting their feet and who is the dog getting yanked.
That is a perfect visualization. If Toronto's price deviates from the one-to-one law, and New York barely twitches while Toronto scrambles to correct its own price to match Wall Street, then New York is the human. New York is holding the leash.
And we have to remember the context we established earlier. The entire history of traditional finance theory said that Toronto should be holding the leash.
Absolutely. Toronto is the home market. Toronto has the local headquarters, the local news, the domestic investors. Toronto should be the human.
But what did the data actually say? When Eun and Sabherwal crunched the numbers on those 124 days of 10-minute intervals, who held the leash?
The numbers are staggering. They completely validate the panic of the Toronto Stock Exchange. On average, across all 62 Canadian companies studied, the U.S. exchange accounted for 38.1% of the total price discovery.
We really need to let that sink in. Close to 40% of the pricing power of a sovereign nation's core corporate assets was hijacked by Wall Street.
Nearly 40% of the fundamental truth about what a Canadian asset was worth was not being determined by Canadians. It was being dictated by traders sitting in Lower Manhattan.
That is a massive paradigm shift.
It definitively proves that the geographic location of a company's headquarters, the flag flying outside their office, it does not guarantee pricing sovereignty.
And as shocking as that 38.1% figure is, it's just the average. And averages can mask some really terrifying extremes.
Oh, absolutely.
When you look closely at the scatter plot of the data, the visual representation of this, the reality is much darker for the home market.
The tipping point is brutal. Out of the 62 companies they tracked, the U.S. prices pulled harder for the vast majority of them, specifically 45 companies out of 62.
For 45 national companies, the U.S. had more gravity.
But for 17 specific corporate giants within that group, it wasn't just a tug of war, it was an absolute rout.
Let's talk about those 17 giants, because for those companies, the U.S. became the absolute, undisputed master of their price. The U.S. didn't just influence them, it owned them.
Complete domination.
And there is one company in the data that stands out as the ultimate nightmare scenario. The absolute worst-case scenario realized in flesh and blood.
You were talking about the Biovail
The
Corporation.
Biovail tragedy. I want to spend some time here. What exactly happened to Biovail? Because this is the ultimate cautionary tale of cross-border listing.
Biovail was a major pharmaceutical company. At the time, they were a massive point of national pride for Canada. They developed vital drugs, they employed highly skilled scientists, they were a jewel in the Canadian corporate crown.
Right.
But when they cross-listed, their trading volume completely migrated south. A massive 83% of Biovail's total trading volume moved to the United States exchanges.
83%.
Yeah.
So almost all the actual buying and selling left home. The local Toronto market was just left with scraps.
Yes. And the consequences for their price discovery were devastating. When Eun and Sabherwal looked at the error correction model specifically for Biovail, they looked for that flinch we talked about.
Right. When the U.S. price and the Toronto price for Biovail drifted apart, what happened?
The data showed that the U.S. price literally did not adjust to Toronto at all.
It didn't even twitch.
The adjustment factor for the U.S. side was mathematically insignificant. It was a flat zero. That means Toronto had to do 100% of the accommodating. Every single time a price gap opened up, the New York traders ignored it, and the Toronto market makers had to run in a panic to change their quotes to match the Wall Street price.
But wait, if I'm a local market maker in Toronto and Biovail is a Canadian company, why do I have to capitulate so totally? Why can't I just say, no, I know the value of this drug pipeline better than you do. I'm keeping my price here.
Because if 83% of the liquidity is in New York is where the informed institutional money is moving. If you stand your ground in Toronto with an outdated price, the arbitrageurs will recognize that you are the one out of step.
Because they follow the volume.
Exactly. They will flood you with orders, buy all your underpriced shares, and bleed your capital dry in minutes. You submit, or you go bankrupt.
So what does this all mean for the Toronto Stock Exchange in relation to a flagship stock like Biovail?
It means, in the cold terminology of the researchers, Toronto was reduced to a pure satellite. A shadow market.
A shadow market.
They were merely echoing, on a millisecond delay, the financial truth that was being established 500 miles away in New York. They had zero independent voice in what their own domestic pharmaceutical giant was worth.
That is the literal definition of a hostile takeover of price. It's chilling. A local exchange reduced to a pure satellite for its own national pride.
It's the starkest example in the data.
But as terrifying as the Biovail story is, the deep dive shows it wasn't a universal slaughter, right? There was a flip side. Amidst all this surrender, there was a fortress.
Yes, there were survivors. 4 companies in the entire study showed total, absolute immunity to Wall Street's gravity.
The sovereign giants. Who were they and how did they survive?
They were the absolute bedrock of the Canadian economy. We're talking about BCE Inc., which is a massive telecommunications giant, and 3 sovereign-level financial institutions, the Bank of Montreal, the Royal Bank of Canada, and the Toronto Dominion Bank.
The untouchables. The banks and the telecom monopoly. Why couldn't Wall Street break them? Why couldn't Wall Street steal their pricing power the way they stole Biovail's?
The answer is entirely, 100% found in the trading volume. For those 4 specific companies, their U.S. trading volume was a paltry 5.5%.
5.5%.
That's nothing. The vast, overwhelming majority of their shares, almost 95%, traded right at home in Toronto.
And because the volume stayed home, the power stayed home.
Exactly. The data showed that for these 4 giants, the dynamic was totally reversed. The Canadian price completely ignored Wall Street's deviations.
Oh, really?
Yeah. If New York traders got excited and pushed the price of the Royal Bank of Canada up, Toronto didn't flinch. Their adjustment coefficient to the U.S. price was completely insignificant. For these 4 companies, Wall Street was a satellite.
This brings us to a massive fundamental realization for any listener who cares about national economics. Financial sovereignty is not a birthright.
It really isn't.
It's not granted to your country simply because you put a flag on your corporate headquarters or because your CEO has a local passport. It is actively earned, and it is earned by keeping your trading volume at home.
But that raises an incredibly urgent question. We see that volume is the shield and volume is the weapon. But how exactly does Wall Street steal that volume in the first place? I mean, Wall Street doesn't use magic. They can't compel Canadian investors to trade in New York.
No, they don't use magic. They use a formula, a cold, highly calculated 3-step formula. Wall Street has 3 passwords to financial domination.
And once you see how these passwords work, you realize how mathematically inevitable this whole migration of power truly is.
Let's break down these passwords, because this is the core of how the capital war is actually fought.
Yeah.
Password number 1, the dictatorship of volume. Or, put simply, liquidity is power.
Right. Let's unpack the math behind this first password. The researchers ran a regression analysis and found a highly significant, undeniable mathematical correlation. It's essentially a straight line on a graph.
Okay, a straight line.
The higher the share of U.S. trading volume a stock has, meaning the more its shares are bought and sold in New York relative to Toronto, the higher the U.S. pricing power becomes. It is an ironclad rule of market microstructure.
But I need to challenge this because I want to make sure we truly understand the why. If I go to a local farmer's market, the vendor selling the highest volume of apples doesn't necessarily get to dictate the global price of apples. Why does volume equal truth in financial markets?
That is a great distinction. In physical goods, volume might just mean you have a lot of supply. But in financial markets, volume equals information.
Information, okay.
We have to look at this from the psychological perspective of a market maker. Imagine you are sitting at a trading desk in Toronto. Your entire job, your legal obligation to the exchange, is to provide liquidity. That means you have to constantly offer a price you're willing to buy at and a price you're willing to sell at all day long.
Okay, I'm at my desk. I'm making the market.
Suddenly, you look at your terminal and you see massive, heavy order flows. Thousands and thousands of shares being executed down in New York for a Canadian stock you are making a market in.
A freight train of foreign capital is moving.
Exactly. If you're that local Toronto market maker, you immediately get spooked. Because in finance, someone moving that much volume usually knows something you don't.
Maybe a hedge fund in New York got an early tip on an earnings report.
Or maybe a major institutional player is liquidating their position. You don't know what the information is, but you know the volume is moving. You have to align your local price to the U.S. price immediately to protect yourself.
Because if I don't,
If you stand your ground and keep your price artificially high while New York is aggressively dumping shares at a lower price, the market will exploit you. Arbitrageurs will buy the cheap shares in New York and sell them to you at your outdated higher price until you are completely out of capital.
you submit to the volume or you die.
You submit to the volume to survive. Liquidity is the ultimate weapon because it carries the threat of superior information.
Which brings us to the second password. If volume is the brute force, this next one is the stealthy, invisible killer. Password 2, the invisible penny war.
Yes, this password is all about the bid-ask spread.
Let's define the bid-ask spread quickly for the listeners so we're all on the same page. The bid-ask spread is just the difference between what a buyer is willing to pay, the bid, and what a seller is willing to accept, the ask. It's the middleman's cut, the transaction cost.
It's the toll booth on the financial highway.
A perfect way to visualize it.
Yeah.
And the study found another highly significant statistical correlation here, right?
Yes. The lower the bid-ask spread in the U.S. compared to Canada, the more pricing power the U.S. steals.
But wait, we are talking about microscopic pennies here. A fraction of a cent in trading friction. How can a fraction of a cent dictate national asset sovereignty?
Because the smartest, most aggressive, most heavily capitalized traders in the world, the ones who actually possess real market-moving information, are hypersensitive to transaction costs. Think about it at scale.
Okay, at scale.
If you are a retail investor buying 10 shares, a 1-cent spread costs you a dime. You don't care. But if you are a massive institutional whale and you need to reposition a portfolio by trading 1 million shares, a 1-cent difference in the spread costs you $10,000 instantly.
Wow. So they ruthlessly hunt for the cheapest market.
They migrate their order flow exclusively to the exchange with the tightest spread. In 1998, due to various structural advantages, the U.S. exchanges often offered tighter spreads than Toronto. So naturally, the informed, high-volume traders moved their business to Wall Street.
And remember, password 1, volume equals information, and information dictates price.
Exactly. Because Wall Street offered a cheaper toll booth, they attracted the smartest traffic. And wherever the informed traders go, true price discovery follows.
That is incredible. Toronto was literally losing its financial borders, its sovereign control over its own national champions, due to a microscopic paper cut of trading fees.
It is the ultimate death by 1,000 cuts. Or, more accurately, death by 1,000th of a cent. The absolute cost of trading dictates the geographic location of financial truth.
Okay, so Wall Street uses massive volume, And they attract that volume by offering tighter, cheaper spreads. But we need to get even more granular. Who is actually pulling the trigger?
Right, who are the actors?
Yeah, who are the specific actors executing these trades that move the needle and steal the pricing power? That brings us to password 3, the stealth hunters.
This was, without a doubt, one of the most surprising and counterintuitive findings in the entire data set. The researchers didn't just look at the total volume, they categorized the volume by the size of the individual trades that were dictating the price.
Now, if I am trying to guess who moves the market, I would assume it's the massive trades, right? The institutional whales dropping million-share block orders. Surely they're the ones setting the price.
You would assume so because they have the most capital, but the data said no. Large block trades, which the researchers defined as anything over 10,000 shares in a single order, did not significantly correlate with price discovery. The whales weren't driving the truth.
Okay, if it's not the whales, what about the swarm? What about the day traders? The retail rookies moving fast, trading 100 shares here, 200 shares there.
The researchers checked that too. Small trades, defined as anything under 2,500 shares, also had absolutely zero significant impact on setting the true price. The retail noise is just that noise. It doesn't shift the equilibrium.
Hold on, I need to stop you. So it's not the billionaires dropping massive blocks, and it's not the millions of day traders. Who is left?
The revelation is that the pricing power lives almost exclusively in the middle. It lives in the medium trade bracket.
Trades between 2,501 and 10,000 shares. That is where the power actually lives.
Exactly. That specific, seemingly arbitrary bracket is the engine of price discovery.
Let me try to wrap my head around this because it's wild. It's like looking for the real card sharks in a Vegas casino.
Oh, I like this.
Right. If you want to know who is systematically draining the house for millions of dollars, you don't look at the noisy tourists playing the penny slots by the entrance. They're making a lot of small bets, but they don't know what they're doing. They're the retail traders.
Right, the noise.
And you also don't look at the flashy billionaire VIPs sitting in the glass-enclosed high-roller room, making million-dollar bets where every security camera, every pit boss, and every cocktail waitress is watching their every move. The house sees them coming from a mile away. They are the block traders.
So who do you look for in this casino?
You look for the guy quietly making $5,000 bets at a crowded, ordinary blackjack table on the main floor. He's trying to blend in. He looks perfectly normal, but he is methodically counting cards, executing a flawless mathematical strategy, and bleeding the casino dry without triggering the alarms.
That is a brilliant analogy, and it maps perfectly onto market microstructure. The researchers and market professionals call this stealth trading. The truly informed traders, the aggressive hedge funds, the corporate insiders, the people who possess real, non-public market-moving information do not want to be seen. They are terrified of signaling their intentions to the broader market.
Because if they show their hand.
Exactly. If an informed hedge fund drops a massive 50,000 share block order to buy, the whole market instantly sees the VIP in the glass room. The market makers immediately realize, oh, this guy knows the stock is undervalued, so they instantly raise their asking prices. The price runs away from the hedge fund before they can fill their whole order, destroying their profit margin.
So what is their strategy? How do they deploy their capital without raising the alarm?
They break their massive informed orders up into medium-sized chunks. They use algorithms or skilled brokers to slice a 50,000 share order into 10 separate 5,000 share orders. They feed them into the market quietly over time, blending in with the regular uninformed institutional flow.
They hide their footprints in the crowd.
And what Eun and Sabherwal's data definitively proves is that wherever these stealth medium-sized trades happen, true price discovery follows.
And the U.S. markets were capturing those.
Yes. Because of their deep liquidity and tight spreads, they were capturing a significantly higher proportion of these medium stealth trades. And therefore, they were capturing the truth.
So let's recap the 3 passwords to financial domination. Password 1 is volume, crushing the local market makers with order flow. Password 2 is microscopic penny spreads, attracting the smartest money by offering a cheaper toll booth. And password 3 is the stealth hunters, capturing the medium-sized block trades where the informed money hides.
That's the playbook.
Wall Street used all 3 of these passwords to crack the Canadian market wide open. But here is where this deep dive gets even more granular and, frankly, even more fascinating. Because even within the borders of the American empire, not all financial predators are created equal.
The data reveals that the very physical DNA, the structural architecture of a stock exchange, decides how brutally and efficiently it can extract pricing power from a foreign nation.
We are talking about an internal American heavyweight fight. The New York Stock Exchange versus the Nasdaq. Which one is the ultimate predator?
The researchers wanted to know if the type of exchange mattered, so they controlled for all the other variables we just discussed. They mathematically leveled the playing field for volume, for spread, for the size of the company. They isolated the data to see if the physical structure of the exchange itself was a factor.
And was it?
It mattered immensely. The NYSE was significantly, measurably better at stealing price discovery from Toronto than the Nasdaq was.
I need you to explain why, because my intuition says the exact opposite should be true. Let's look at the late 90s. The Nasdaq was a flashy, high-tech darling. It was a completely electronic network of computers. The NYSE, on the other hand, was still fundamentally a room full of guys in colored jackets screaming at each other on a wooden floor in Lower Manhattan. You would naturally assume the high-tech digital computer network would be the ultimate efficient predator.
The Nasdaq certainly had the technological veneer, but it suffered from a fundamental genetic flaw in its market structure: fragmentation.
Fragmentation, what does that mean in this context?
The Nasdaq, by its very design, operated as a decentralized dealer market. There wasn't one single point of contact. There were multiple competing market makers spread out across a network for a single stock.
And why is that a flaw when it comes to setting a price?
Because of how orders were routed, the Nasdaq engaged heavily in something called preference trading. This meant that brokers would route their customer orders to specific dealers based on pre-existing financial relationships or payment for order flow, rather than just sending it to a central pile. They were often negotiating deals off to the side, away from the central public screen.
So the information is scattered. It's happening in dark corners and private phone lines.
Exactly. That structural fragmentation dilutes the purity of the information. If an informed stealth trader is executing medium trades, but those trades are scattered across 10 different dealers who aren't perfectly sharing information, the price signal gets muddy.
And the New York Stock Exchange.
The NYSE at that time was a pure, centralized auction-style floor. Every single order for a specific stock, whether it came from a retail broker in Ohio or a massive hedge fund in London, flowed through one single physical point, the specialist post on the trading floor.
It was a funnel.
A single, incredibly efficient, inescapable funnel. Every piece of information, every bid, every ask, every median stealth trade collided in one physical space in front of one human specialist. Because of that extreme centralization, the NYSE was a ruthless, pure engine for processing information and churning out a true, undeniable price.
Centralization defeated fragmentation.
The transparent, screaming floor defeated the opaque, scattered computer network.
It is wild to think about. The physical architecture of a chaotic room in Lower Manhattan was mathematically better at stripping sovereign pricing power from a foreign nation than a web of advanced computers. But the data proves it.
And we can say with absolute certainty that the data proves it because the researchers didn't just publish their initial findings. They subjected their own data to a statistical torture chamber to ensure they weren't being fooled by random noise.
I want to talk about this stress test. Because if I'm a listener, or perhaps a patriotic Canadian economist, I might be listening to this and looking for a reason to dismiss it. I might think, okay, maybe this was just a fluke. Maybe 1998 was a weird, volatile year. Maybe Biovail and a few other extreme outliers skewed the average, and the reality isn't that bad.
And academics are incredibly paranoid about exactly that. They are terrified of statistical flukes. So Eun and Sabherwal took their error correction model and actively tried to break it. They ran robustness checks. Think of it like a funnel, stripping away potential errors. First, they threw out the statistical outliers. They removed the companies behaving strangely at the extremes to see if the core finding held up.
And it did.
It did. Then they altered the volume thresholds, removing the most thinly traded stocks, the illiquid companies, where a single trade might heavily skew the price.
And the result?
The result held. Then they brought out the heavy statistical artillery. They ran the data through incredibly intense mathematical frameworks.
Okay, the paper mentions things like Tobit models and heteroscedasticity consistency. I know we want to keep this accessible, but you have to explain what those actually are, because just hearing the word sounds like an academic torture device. What is the Tobit model actually doing to the data?
It sounds intimidating, but it's a brilliant tool. Think of a Tobit model like fixing a broken speedometer in a car. Imagine you have a car that can go 120 miles per hour, but the speedometer dial physically maxes out at 100. If the car is going 120, the dial still just says 100. In statistics, that is called censored data. The true value is hitting a ceiling or a floor, so the data you see is artificially capped.
How does that apply to stock prices?
In financial markets, especially when measuring who contributes to price discovery, you might have moments where the U.S. contribution hits a mathematical ceiling of 100% or a floor of 0%. Regular statistical models get confused by this. They treat the ceiling as a normal data point, which skews the trend line. A Tobit model mathematically accounts for the fact that the data is hitting a wall, adjusting the curve to reflect the true underlying reality.
That makes perfect sense. And what about the heteroskedasticity?
Heteroskedasticity is a fancy word for unpredictable, exploding volatility. In financial data, errors don't always behave neatly. Sometimes a market is calm and the data points are tightly clustered. But if a massive news event breaks, the volatility explodes and the data points scatter wildly.
Right.
If you use a basic statistical model, that explosion of volatility can create a fake correlation. It can trick you into seeing a pattern that isn't real. By using heteroskedasticity consistent models, the researchers mathematically smoothed out those explosions, ensuring that the relationships they found weren't just mirages caused by panic selling.
It is the statistical equivalent of a stress position. They threw every complex variable, every cap, every volatility explosion at their hypothesis to find any weakness in the correlation. And the result of all this mathematical torture.
The truth survived the interrogation completely intact. The three passwords, the dictatorship of volume, the invisible penny war of spreads, and the dominance of medium stealth trades remained cold, unmovable facts. There were no statistical mirages. The hijacking of price discovery was real, it was measurable, and it was statistically bulletproof.
Okay. We have spent, well, a long time deep in the weeds of 1998 market data, dissecting arbitrage, algorithms, and market structures. But now it is time to pull back. We need to look at the macro picture.
The big implications.
Right, because the implications of what we've unpacked here are absolutely staggering for the modern world. If local brokers, sitting in their home country, are mathematically forced to use foreign prices to verify the value of their own local trades, does a national financial border even exist anymore?
This is the exact regulatory shockwaves that this study created when it was published. Let's go back to the beginning. Remember we talked about the Toronto Stock Exchange begging the U.S. Securities and Exchange Commission for help?
Yes, the TSE was panicking, and they wanted U.S. regulators to force American brokers to acknowledge the Canadian market when executing trades. They wanted a mutual border.
Well, the devastating irony of this deep dive is that it proves the exact opposite is actually the urgent reality. It isn't just about the U.S. looking at Canada. It is about the absolute necessity of Canada looking at the U.S. Every stockbroker, everywhere in the world, has a strict legal and ethical obligation known as best execution.
Break down best execution for us.
It means that if you give your broker an order to buy 100 shares of a stock, they are legally required by their regulators to go out into the market and find you the absolute best possible price available at that exact second. They cannot just lazily fill the order at a bad price if a better one exists somewhere else.
That makes sense. It protects the investor.
It does. But here's the paradox. If close to 40%, and in the case of a company like Biovail, up to 98% of the true price of a Canadian stock is being determined dynamically in New York,
then a Canadian broker, sitting in an office in Toronto, taking an order for a Canadian stock from a Canadian client, must constantly look at Wall Street to fulfill their legal duty.
they have absolutely no choice. To fulfill their legal obligation of best execution, they must treat the foreign market as the primary source of truth. The geographic border drawn on a map is rendered entirely functionally meaningless.
Because if the undeniable price truth lives 500 miles away in a different country, your local exchange is just an echo chamber. It's a printer spitting out yesterday's news.
A phantom border.
But wait, I want to explore a defense mechanism here. We mentioned earlier that Canada was particularly vulnerable to this hostile takeover because it shared a time zone with Wall Street. They were fighting face-to-face in the exact same hours.
The time zone overlap was indeed their greatest vulnerability. It allowed the arbitrageurs to operate instantaneously.
But doesn't that mean European and Asian companies are safe? Think about it. When a massive Japanese tech company or a British bank cross-lists in New York, they have the ultimate shield: geography.
The physical distance.
Right. They use those messy ADRs, the depository receipts we talked about, and more importantly, their home markets are asleep when Wall Street is trading. Doesn't that physical separation protect their pricing sovereignty?
In 1998, when the study was conducted, yes, that geography provided a very real, very effective temporary shield. The sheer friction of dealing with ADR conversions combined with the barrier of time zones kept the high-speed financial snipers at bay.
It gave them a buffer.
Exactly. It allowed the local markets in London, Frankfurt, or Tokyo to wake up in the morning, digest whatever happened in New York overnight, and consciously set their own opening prices before the U.S. market even turned its lights on.
So they had a moat, a physical temporal moat protecting their financial castles.
They had a moat, but we need to extrapolate the findings of this 1998 laboratory to the present day. What happens to a medieval moat when the fundamental rules of physics change?
The moat evaporates.
Exactly. Canada was simply the first to fall because their moat evaporated first due to geographic proximity. They were the canary in the coal mine. But look at the markets today. Digital trading operates at the literal speed of light across fiber optic cables spanning the oceans. We have dark pools, highly advanced algorithmic trading, and global electronic communication networks.
The market doesn't actually sleep anymore.
It doesn't. That last geographic moat, the protection of the time zone, is completely evaporating as we speak. The friction of ADRs is being smoothed over by incredibly complex high-frequency algorithms that can calculate currency risk and conversion fees in nanoseconds. The financial snipers don't go to sleep when the sun goes down in New York.
The stealth hunters are always hunting.
Always. And the arbitrage rubber band is now wrapping around the entire globe, which leaves us with a terrifying, inescapable reality. If we accept password one that liquidity is power, and we know mathematically that it is,
then we have to face the fact that global liquidity is currently being irreversibly sucked into massive, centralized, super financial empires.
Wall Street being the black hole at the center of it all.
Wall Street, and perhaps one or two other massive global hubs like London or Hong Kong. But the fundamental concept of a sovereign, isolated, strictly domestic stock market determining its own fate.
That concept is dying. It might already be dead.
Are we currently living through the twilight of national financial sovereignty?
I think we are. The data from this perfect laboratory in 1998 showed us the exact blueprint of how sovereignty is lost. It is not lost by military invasion. It is not lost by dramatic political treaties. It is lost by the relentless, invisible, mathematical pull of trading volume and market efficiency.
And so I want to leave you, the listener, with a chilling question to mull over. As we plunge deeper into a fully digitized, borderless global market, when every major corporate asset in the world, from the banks that hold your mortgage to the telecom companies that route your data, is ultimately priced by one massive supercenter of liquidity, who really controls the global economy?
It's the ultimate question.
Do the politicians sitting in your local capital control it? Or do the algorithms humming in server farms in New Jersey control it? Because as we've learned today, the victory lap is a lie. It's a silent surrender. The company rings the bell, the confetti drops, everyone cheers, and your financial borders vanish into thin air.
And no one even notices.
It is a question you absolutely have to ask yourself the next time you see a beloved local champion celebrating their global debut on Wall Street. Look past the smiles, look past the cheering, and ask yourself, who is really holding the leash?